So after we've collected the trash on the Chesapeake Bay banks, there's not really a good way to pull it out other than just stomping through the mud and muck. But there are good ways to pull money out of your life insurance policy. So before you go ahead and surrender that plan to try and recoup some of your Christmas time losses, first is going to be what's called a withdrawal. So instead of you completely dispersing and surrendering your plan in its entirety and pulling out all the cash, you can actually just withdraw a portion of your cash, and your insurer will permanently reduce your death benefit by some proportionate amount. Doing this allows you to keep some sort of death benefit intact. And because that money is still tied to an active life insurance policy, any gain you've made on your cash will not be taxed. The second is probably the most popular way of getting cash out of your life insurance policy, and that's through a policy loan. A policy loan is exactly as it sounds. You take money out of the cash value with a promise to repay that money. Now, of course, it's your money, so you don't have to actually repay the money to still be covered, but the insurer will still charge you an annual interest rate due on the loan balance. So in order to keep your policy from losing additional cash, you need to make sure you pay that. The reason why using the policy loan method is so popular is because your cash is actually separated into two different accounts within the policy. There's your policy value account and your cash surrender account. The policy value account balance is what you actually receive interest rate on. The cash surrender account is what you have due to you if you were to cancel the policy. And once you've cleared whatever time period your policy puts on you to have to pay cash surrender charges, which is the early access charge for canceling the policy, your policy value and cash surrender value will mirror each other from that point out. So when you access that cash as a loan, it pulls it from the cash surrender value but does not pull it from the policy value, which means you continue to generate and accrue interest on money that you actually took out. And in many cases, that interest rate on that ghost money actually nullifies any interest rate on the loan. And lastly, we have what's called a viatical settlement, and this even applies to term plans that don't traditionally accrue cash. A viatical settlement is when you find an investment company that actually wants to purchase your plan from you. This means they give you a lump sum of cash for you to sign over the rights to your plan. Of course, they then become the beneficiary, and when you pass away, they get the death benefit. Well, this is often only available for those in a select health category and of a certain age. But depending on the circumstances, these cash payouts can be much higher than what the cash surrender value actually was in the policy, which means you get more money. And once again, this also applies to term plans where there was no cash accrual at all.